Hey guys, welcome back to another video. In this video, I'm going to be talking about Super Microcomputer, which is a stock that has been outperforming Nvidia over the last 12 months. We can see year to date, this stock is up 170%, Nvidia is up 75%, and the rest of the market is up 7%. And over the last 12 months, Super Microcomputer is up 620%, while Nvidia is up 200%, and the rest of the market is up 22%. So obviously these are pretty impressive returns, and so in this video we're going to talk about this company, look at their financial results for their most recent quarter, and then also we are going to use a discounted cash flow model to calculate the intrinsic value per share for Super Microcomputer so we can know if it currently presents a good buying opportunity at the current share price. So for their business model, Super Microcomputer essentially makes money by designing, manufacturing, and selling high-performance data center servers and storage systems. They sell these systems to different markets, including the cloud sector and companies that require strong data centers for their business operations. These products are sold worldwide through their network of distributors, allowing them to diversify their revenues across different revenue regions. And then also they provide IT support for their customers, allowing them to build relationships with their customers outside of just a one-time sale of their data center products. The company lastly also invests very heavily in research and development to stay at the forefront of trends in the tech sector, such as green computing and high-density server technology, with a focus on innovation to maintain their competitive edge in the market. Over the last year, Super Microcomputer's market capitalization has grown from $7 billion at the start of the year, or at the start of 12 months ago, so essentially in April or May of 2023, to what is now $45 billion. So it has more than tripled the return of Nvidia over the last year, and it has basically increased in market cap by a multiple of 6. So pretty impressive growth. If anyone was invested in Super Microcomputer over the last year, then they've probably experienced one of the best returns in the entire stock market over the last 12 months. So now I wanted to look at this article that's titled Super Micro Pushes Up Full Year Revenue Forecast as it points to strong artificial intelligence demand. We can see some key points here they touch on, one being that Super Micro's revenue surged 200%, but was still slightly below the analysts' estimates. And also the company recently replaced Whirlpool in the S&P 500 in March. So that's another key point that I didn't mention at the start of the video, is that Super Microcomputer, as a result of their market capitalization growing by a multiple of 6, recently ended up joining the S&P 500. So a lot of good news recently coming out for Super Microcomputer. And considering the fact that their market cap is still only about $45 billion, they definitely still have a lot of room to grow. We can see right here, they point out that Super Micro shares slipped as much as 15% in trading on Tuesday after the server maker reported slightly lower revenue than expected for its fiscal third quarter. Pretty impressive that this stock slipped 15% and yet it's still up 600% all time. We can see that when it was at its all-time highs on March 13th, it was up over 1,000%. Since then, it's obviously slipped quite a bit down to the 700s from where it was in the 1,000s, so it could present a good buying opportunity right now. But let's keep looking at the article. Right here, they point out that the company's revenue jumped 200% year over year in the quarter, which ended on March 31st, and that's compared with a 103% year over year increase in the previous quarter. Net income came out to $400 million or $6 per share, compared to $85 million or $1 per share in the year ago quarter. Obviously, that's extremely massive revenue and earnings growth. That's the best revenue and earnings growth that we've seen for the first quarter of the year so far out of any company we've looked at. We can see right here, they point out that not including the after hours move, Super Micro stock is up 205% so far this year, while the S&P 500 has gained by 6%. And then also last year, investors were keen to bet that Super Micro would become a key provider of servers containing Nvidia graphics processing units for working with artificial intelligence models, pushing the stock up 246%. And also they point out that in March, Super Micro joined the S&P 500, and if it weren't for a key component shortage, Super Micro would have delivered more during the quarter. said their CEO during their earnings call. And he said he expects artificial intelligence growth to remain strong for many quarters, if not years to come. The fast growth required the company also to raise a lot of capital through a secondary offering this year, which we can get a better look at through their financial statements. So right here, this is their income statement for the third quarter of 2024 compared to 2023. And we can see revenue was about $3.8 billion, which is up 201% as stated in the article from about $1.28 billion year over year. And we can see that their net income increased by about 373% from $85 million to $400 million year over year for the third quarter of their fiscal year 2024, which is actually the first quarter of the calendar year. Then we can also see the results for the first 9 months. Revenue increased from about $5 billion to almost $10 billion, so basically almost a 100% increase there. And then earnings increased from about $400 million to about $800 million, so also about a 100% increase year over year for the first 9 months of their fiscal year. Then obviously we saw in the article, they pointed out that because of this massive amount of growth, they had to raise more capital through a secondary offering. And we can see that from their balance sheet right here, where they show that for the period ending March 31st, 2024, compared to the prior period of June 30th, 2023, we can see their equity increased from about $2 billion to $5 billion, mainly as a result of an increase in common stock and additional paid-in capital of about $2.8 billion. This, of course, means that Supermicro issued more shares of common stock in order to raise capital to fund their business operations, which typically isn't really a good sign for shareholders, because you want to see that a company is buying back stock, not issuing more shares, because that ends up diluting previous shareholders, which might have contributed to the decline in the share price that we see right here from their stock chart. But if they're able to continue to increase their revenue and earnings in the future, which the article highlighted they expected to, then their stock price might end up rebounding from here and growing even more in the future. So now I wanted to look at this DCF model to try to calculate the intrinsic value per share for Supermicro. I'm using a growth rate of 21%, which I got from the growth rate of their free cash flows over the last 5 years, from about $240 million in 2019 to $630 million in their most recent full fiscal year. That's a historical annual growth rate of 21%. To calculate the discount rate, I used a weighted average cost of capital of 8% using this calculator right here. You can pause the video to take a better look at it if you'd like. We can see they have about 58 million shares outstanding. And so with these metrics in mind, their intrinsic value per share is estimated to be about $320 per share based on these assumptions, which does put their stock currently at an overvaluation at $750 per share. Keep in mind, 12 months ago, they were at $130 per share. So at that point, you could say they were trading below intrinsic value. But as of right now, based on these assumptions, they are a little bit overvalued. But like I said, if they're able to continue growing their revenue and earnings, then this metric can obviously change quite drastically. And this DCF model is using a lot of assumptions. Some of them could be a little bit too pessimistic or a little bit too optimistic, and that could also contribute to a varying intrinsic value estimate. Next, I wanted to compare Supermicro to some of the other competitors in their industry, two of which are Google and IBM. We can see that from this comparison here that Supermicro has the highest return on equity, which is to be expected because we can see that their stock price return was better than Google and IBM over the recent year. But unfortunately, we can see that for profit margins, Google and IBM are way outperforming Supermicro Computer. Google way ahead of everybody else with a 24% net profit margin. None of the companies pay a dividend except for IBM, which is paying a 4% dividend yield, which is quite high. And we can see that Supermicro has the highest PE ratio and the highest price to cash flow ratio, which could mean that investors are already pricing in that Supermicro is going to grow much faster than Google and IBM in the future. But that being said, Google and IBM also have other parts of their business that Supermicro just doesn't have, because Supermicro is a lot more of a niche business, whereas Google is a lot more diversified. But just based on this comparison alone, we can see that Google is probably doing the best out of the three companies from a profit margin perspective. Then lastly, I wanted to compare Supermicro to other companies we've looked at on this channel so far. Based on intrinsic value, we saw that Supermicro was not trading below intrinsic value, so they don't make it onto the table with the other companies that were trading at a good share price compared to their intrinsic value per share. We can see that for growth rate, Supermicro had a 21% growth rate, which puts them in 9th place compared to all the other companies we've looked at. We can see one of their key competitors or complementary companies is Nvidia with 44% growth. They don't pay a dividend, so they don't make it onto the dividend table. For gross profit, we can see Supermicro had an 18% gross profit and 9% net profit, which isn't good enough to get them onto either of the profitability tables. But we can see that for Q1 2024 year-over-year revenue and earnings growth, Supermicro had 200% revenue growth and 373% earnings growth, putting them in first place ahead of Tesla and Broadcom, which are the only other two companies we've looked at so far for the first quarter of the calendar year. And then lastly, for stock performance over the last 5 years, we can see that Supermicro is up 3,313%, which is a lot better than every other company we've looked at, including Nvidia, Tesla, Kurasushi, AMD, and a bunch of other super high growth companies that we've looked at on this channel. So let me know in the comment section down below what you guys think of Supermicro Computer. Is it a buy at the current share price? Let me know your thoughts in the comments down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.